This isn't the world you grew up in. You've become an expert in areas of the business that go well beyond tax. Your organization is more global, increasingly digital. Your business models are more complex. Compliance is getting complicated, and penalties are more severe. Governments around the world have moved towards taxes that are easier to collect and administer through technology. Suddenly, your board wants to hear from you about risks and opportunities, and you're not the tax leader you were when you started out. You know how to transform your tax data into meaningful insights. And if you're anything like the other ambitious, future-thinking tax leaders out there, you've managed to do all of this with fewer resources and less budget. Maybe these tools still feel disconnected from one another. Not anymore. Introducing KPMG Digital Gateway, the single platform solution that gives you access to the full suite of KPMG tax and legal technologies you use. Across our global network, we are investing $5 billion over 5 years in technology, people, and innovation to accelerate the digital transformation of KPMG firms and our clients, and more than $1 billion in tax and legal technology specifically in that period. KPMG Digital Gateway puts the fruit of our investments at your fingertips, bringing together the expertise of alliances, technology solutions, and the KPMG global network of professionals into one integrated platform. Putting our investments in machine learning, deep analytics, visualizations, and AI technologies in one place, all driven by the rich data you already have on hand, powered by Microsoft Azure, built on the cloud. KPMG Digital Gateway and the teams behind the solutions are working together to help change the lives of tax leaders and their teams, redefining target operating models and transforming tax functions for the new world order. You've done so much already. Just imagine what the future of tax will be with a platform like this behind you.
Good morning, everybody. Thank you for joining us today on the July edition of the KPMG Social Media Tax Chat for 2023. My name is Ademola Adegoke, and I'll be your moderator for this session, effectively facilitating the discussion around what is the critical subject matter of the Finance Act 2023. The topic which we'll be discussing today is enhancing Nigeria's business landscape and overview of the Finance Act 2023. On the 28th of May 2023, His Excellency former President Muhammadu Buhari signed the Finance Bill 2023 into law as the Finance Act 2023. The Finance Bill 2023 was an executive bill prepared by the then Honorable Minister in consortium with the private sector and stakeholder engagement, active stakeholder engagement. And this was intended to be presented by the President Muhammadu Buhari together with the 2023 budget to the National Assembly. As we know, it has become an annual tradition for a Finance Act to accommodate or to accompany the annual budget, and this has been a recurring theme since the first Finance Act of 2019. This year's Finance Act introduces changes to the Capital Gains Tax Act, the Companies Income Tax Act, the Personal Income Tax Act, the Customs and Excise Tariffs (ETC) Act, the VAT Act, CPT Act, the Stamp Duties Act, and other tax and non-tax legislation. Per the Act, the effective date of commencement of the legislation is the 1st of May 2023. This has subsequently been modified due to concerns about implementation and timelines by the private sector, and this has been modified by an executive order which was issued by the new president, Bola Ahmed Tinubu. And basically, the effective date will now be 1st of September 2023. The Finance Act 2023 is the fourth in a series of legislative amendments to be enacted by the federal government on an annual basis. And the passage of the Act reinforces the federal government's commitment to making incremental changes to Nigeria's fiscal framework that continues to be pivotal in achieving Nigeria's economic growth and sustainable development objectives. Today, we'll be trying to make sense of the chaos. We'll try to make sense of the Finance Act 2023, what it means for your business, and what it means for everyone who's attending, whether you're private sector or public sector, or whether you're a tax consultant who's just trying to learn more about the tax laws. And joining us to help dissect and make sense of the chaos is Ajibola Olomola, a partner of KPMG in Nigeria. Ajibola is a seasoned and experienced accountant and lawyer, and Ajibola has over 30 years experience in the tax and legal field. Ajibola has been very active in fiscal policy implementation over the last few years, and particularly in the last 4 years, being instrumental and being on fiscal policy committees where the thinking behind some of this legislation was actively discussed and extensively debated. So Ajibola will be joining us shortly to help us comb through and help us make sense of the chaos, like I said. But before I, introduce Ajibola, to basically make his opening remarks, we will be taking an initial set of poll questions. So on your screen, we will have questions deployed very quickly, if that is up. While we wait for the poll questions to come up, I will just allow Ajibola to introduce himself and provide some of his opening remarks. Ajibola, good morning.
Good morning, Goke, and thank you very much for having me over to join you for the social media chat for July of 2023. And we have selected an interesting topic, being the Finance Act of 2023. And it's a matter that's generating active discussions across the fiscal economy. Many people are affected by the provisions of the Finance Act. And of course, there has been a recent suspension by executive order of some of the Finance Act till 1st of September 2023. These are matters that are of interest to taxpayers. What does this mean for the filing of my tax returns? And for companies that have already filed their tax returns, what does this mean for positions they have taken in those tax returns, especially given the intervening period between 30th of June 2023 and 1st of September 2023, which is the new commencement date for the legislation. What does this mean for all of us? There's so many things to talk about around the Finance Acts, but the very first thing to remark upon is that it's the fourth in a series of Finance Acts that has been enunciated by the government as means of reforming, if you like, the tax landscape in Nigeria. So one should at the outset commend the government for the consistency and for the annual review of the fiscal landscape and interventions to give relief to participants in the economy. So my opening remark would be to say it's been a good 4 years for taxpayers and for the tax administrator. And we must credit the government, the FRS, the Federal Inland Revenue Service, the Ministry of Finance, headed by the minister, and everybody that has been involved in moving, if you like, in moving this machine forward. Considerable appreciation must go to the FRS also for very many efforts they have made to engage with stakeholders, explain things to us, give us assurances and comforts when required, introduce technology, and sometimes ease our pain. But like you know, those pains are not completely eased. And the work you and I do on a day-to-day basis is helping clients, if you like, understand what this means for all of them. So it's good to be here. It's a good topic we've selected, and I hope we have a robust discussion this morning.
Thank you very much, Ajibola. You make some very interesting comments there in terms of the effort that's been put in to implement some of these tax changes and the implications it will have for businesses. And I think that's a good place to start. You would know, being close to the issues, that the first Finance Act of 2019, for instance, contained sweeping changes to the tax framework. There were quite significant changes which were intended to modernize, the Nigerian tax framework and bring it in line with global standards. So we had things like the Real Estate Investment Trust Initiative, which was then written into the tax laws to encourage those types of transactions. We had securities lending at the time, and that was also the tradition over the coming years. This year's Finance Act seems to be a slimmer legislation. It seems to be more focused on some key objectives of the federal government, which we understand to be revenue generation. For instance, we've seen an increase in the TET rate from 2.5% to 3%. We've also seen some changes around fiscal equity, trying to balance the treatment for taxes for companies that operate in oil and gas sector under the PPA and under the PIA. So initially, listeners would like to know, for you, what are your thoughts on the Finance Act 2023, and especially, what are the major highlights for you, and how do these changes implemented by the federal government achieve those key objectives which the federal government has made known and made public?
Well, thank you very much, Kuka. And that's a very important question, because sometimes you have to understand the purpose of something in order to understand and begin to anticipate its likely impact. So what is the purpose of the Finance Act of 2023? And you are also quite correct to take a step back in time to 2019, where this journey actually all started with the initial Finance Act of 2019. And if you think back to 2019, there were some key things that the legislation sought out to do. The first was to in a sense, identify a key growth component for the Nigerian economy, which is the small, micro, and medium sized businesses that straddle the entirety of Nigeria, mom and pop shops, one-man businesses, trading outfits, all sorts of businesses across the entire country, farmers and the like, who are actually the fulcrum of the economy. That's the level at which the shoe really pinches. That's where really you start mobilizing capital to galvanize activities in the economy. And the first Finance Act then began to, if you like, provide support to that industry by, creating an atmosphere where, for the smallest of them, those who are earning a certain turnover of a certain rate, up to 25 million, were completely excluded from corporate income tax. That was, in a sense, government putting capital in their hands that they could reinvest in their businesses in the hope that they grow. And when they then grow beyond a certain threshold, which had been set to be 50 and then eventually 100 million naira, then they start paying tax at different rates. That was the journey that started in 2019. And that ecosystem then began to be, if you like, adjusted in 2020, 2021. in the Finance Act of those years. Now, the version of 2023 then begins to look at other sectors to say what else is going on in this economy that we need to bring in from the code. And the very first one, if you like, is the fact that many Nigerians today are familiar with alternative investment schemes through, if you like, digital currencies, digital assets. You know, we're all largely familiar with blockchain technology and some of the very dynamic products that have come into the market on the back of blockchain technology. There are reports that have gone out there that have indicated that Nigerians, if you take a survey of Africa, I've seen reports that suggest that Nigerians as a collective hold more investments in digital assets than any other African country out there. And so that tells you that there's a lot going on out there. But there was a view that the tax legislation, the fiscal legislation, did not make robust provisions for how you treat digital assets. There were questions as to whether, one, the income you make from cryptocurrency, if I just take that as an example of a digital asset, the income you make from trading cryptocurrency, is that taxable under the Personal Income Tax Act? Or if you're a company, the Companies Income Tax Act? Or is that taxable under the Capital Gains Tax Act? Well, in a sense, that debate is not fully answered. But in the Finance Act of 2023, there was an initial categorization of digital assets trade into capital gains, where you now have, in one of the sections of the Finance Act, a definition of digital assets as a chargeable asset for CGT purposes. Of course, you and I being practitioners, we do know that if you were undertaking a business where the active trade is in digital currency, there will still be that question as to whether or not you need to interface with the income tax legislation. But at least we can say that the opening salvo is to place digital assets in the realm of chargeable assets and then encourage, of course, the entire tax system in Nigeria is based on, if you like, self-reporting, self-assessment. So you then require participants in that ecosystem to self-report themselves for tax purposes. And we'll see when the law comes back into operation in September, firstly, whether that provision survives, and two, what protocols are going to be put in place by the tax administrator to then begin to try to harvest, if you like, the tax income arising from trading those assets. Now, digital assets are not the only thing that the Finance Act of 2023 also tries to cover. There are a number of other areas that were also covered. For example, we now live in a post-PIA regime. That's the Petroleum Industry Act. We live in a post-PIA regime where there are, if you like, some matters that were not quite completely taken care of by the PIA in the system of taxation that has been created by that legislation. It's a watershed legislation, robust, exhaustive, but still there are one or two things to be taken care of that have now been taken care of in the Finance Act. And I'm sure in a few minutes' time, we'll be talking about some of those provisions. So if you ask me what I think the areas are that the Finance Act of 2023 have focused on, I would say we saw cleanup of the tax legislation. If you think about cleaning up the tax legislation to take care of PIA, you think about cleaning up the tax legislation to take care of digital assets. So you have the cleanup program that the Finance Act incrementally addressed. You also had a key focus, which seemed to be reforming or signaling the beginning of reform of the tax incentive framework that exists in Nigeria. And we saw the removal of what was perceived, in quotation marks, to be redundant or obsolete tax incentives that have now been removed from the tax lexicon. We also had some provisions that focused on tax administration in itself. So, for example, you had provisions that addressed agents that had been nominated by FRS to be VAT collectors. That was addressed. And then we began to see the introduction, if you like, of green taxes, if you like, that was signaled also by the legislation. So those are key things that the legislation did. It was incremental. Then you have interventions in other non-tax areas. For example, there were changes made to the Corrupt Practices Act to address some gaps. Some changes were made to the Ministry of Finance Incorporated Act, again, to introduce a board. So you had some of those, if you like, other matters that were also addressed by the Finance Act. So it's a mix, it's been a mixed bag. It's a combination of so many themes. But I will say that ultimately, incremental tax revenue is a key objective of this legislation by bringing in from the cold income from taxable activity that previously was arguably excluded from consideration.
Thank you very much, Ajibola, for that detailed answer, which was very expansive and very rich. And from listening to you, it would seem I may have concluded too early that the Finance Act this year was very simple and was something we could delve into very quickly. But there's so many layers to it, which you've mentioned. You've mentioned the issue of digital assets and the complexities around that. There's been quite a lot of conversation around that. You've mentioned the issue of the PIA, the cleanups around the incentives in CETA. You've mentioned, the tax administrative changes to the VAT collection rules. You've also mentioned quite a few things around, the non-tax changes. And, a lot of these are very interesting, which we'll go into. But just to stay on one of the points which you mentioned, which is the conversation around digital assets. And I think a lot of young people, a lot of investors are interested in this area because it's a new trend, which sort of goes hand in hand with what we're seeing in terms of AI today. So you find that, there's a lot of emphasis on digital assets, which comprise cryptocurrency, fungible assets, non-fungible tokens, and the likes. And so this is an interesting area that Nigeria is also, should also be looking at. There's statistics that suggest that 27% of Nigerian internet users own cryptocurrency. There's also statistics that suggest that Nigeria has the highest, cryptocurrency penetration rates or digital asset penetration rate. I think we're second behind South Africa. So really, there's a lot going on in that area. However, there's also the small matter of the CBN intervention, which precludes commercial banks from facilitating transactions in cryptocurrency. So the question that has come up really is, how does this work? On the one hand, the CBN is restricting to a certain degree implementation of cryptocurrency related trade. And on the other hand, this is the federal government and the National Assembly saying we recognize this as a valid fact and we want to tax it. So the question is, how do you see the implementation of this law taking shape? Is it implementable? Is it something that can actually be done? Especially because today you find quite a lot of cryptocurrency transactions are done via peer-to-peer trades and things like that, which generally are under the radar. So how do you see this playing out? Is it implementable? That's the question that people in our audience would like to ask.
It's a very good question again, Goke, and the jury is out. I will share my view, of course, but we all will be entitled to our views on this one. For the first one is that the Central Bank of Nigeria, following advice of the multilateral institutions, the World Bank, have, if you recall, the World Bank did issue warnings to all central banks across the world to be wary of digital assets and cryptocurrency in particular. And the central bank, on the back of that, has, in a sense, discouraged that trade in Nigeria. And in fact, they issued a circular to commercial banks not to offer banking services or allow their banking platforms to be accessed to traders in such currency. So in a sense, that's an outright ban or prohibition, if you like. But that hasn't killed the trade because it's a very topical issue. It's what's going on across the world right now. And then you can have other organizations like the Securities and Exchange Commission that have issued what could be seen to be actually positive and complementary rules that encourage, traders who want to set up trading exchanges and the like to actually seek and obtain SEC registration. The reality of the matter today is that many Nigerians are earning income from trading in digital assets. We're on live TV, so I need to be a bit careful. But the truth of the matter is that the morality of your income is irrelevant to the taxman. As far as the tax authorities are concerned, the revenue planners for the economy, as far as they are concerned, if you have income, regardless of the source of that income, you must pay tax on such income. And remember again that the tax framework in Nigeria is based on self-assessment. You are required to take a view of the entirety of your portfolio, determine what income of yours is taxable, and then submit a return to the tax authority, the relevant tax authority, indicating what income you have earned, what tax you have applied. And one way the tax authorities can always check whether you have made a complete return is by trying to match your return to your lifestyle. So when you say, oh, I don't earn taxable income, but you drive a fancy car, probably live in a very nice part of the town, government reserved area, if you're not in Lagos, or you're living in VI, if you're in Lagos, and you say you don't have income. And then they ask you questions around how you're financing your lifestyle. And then you can have a conversation with them. So there are ways the tax authority will figure this out. They can have access to your bank accounts, like we've seen them do a few years ago, where they obtain downloads of everybody's bank standing, and we're able to determine individuals and corporate entities who had certain amount of accounts and compare that to the data from tax filing. So there are ways the tax authority can become aware whether you have complied with your statutory duty or not. I would rather not go to the level of the tax authority effort. I'd rather stay with the principle that every Nigerian, whether an individual or a corporate entity, has an obligation, a constitutional duty, backed up also by the tax laws, to make a complete return and disclosure of their income to the tax authority. So we need to ask ourselves, how many of us comply with those laws? Because it is the income, it is the revenue that we contribute as part of our social contract with the government. It is the tax that we pay that should be used to finance public services. So we all want palliatives because petrol price is very high. How will the government fund those palliatives? It comes from our tax revenue. Of course, government can also earn revenue from sale of crude oil and any royalties. That's true. But ultimately, government will be financed by our tax revenue. So if we want to be able to live peaceably in this country, access economic markets in this country, participate in logical trades in this country, we should also be willing to pay our own part, to pay our own responsibility under the social contract with the country called Nigeria. So yeah, I would say that's the answer. The framework is still being done. Obviously, the tax authority and the other fiscal planners will have to sit down with the monetary policy experts who are in charge of monetary policy and align their views. Because the monetary policy experts cannot keep telling us that trade in cryptocurrency is illegal, and then the fiscal policy planners are expecting to earn a return from tax on such instruments. I think there needs to be an alignment, and I'm hopeful that that alignment will come very soon. Hopefully, touch wood, before the 1st of September, when this Finance Act will become operational. By then, hopefully, we would have seen some movement in the right direction.
Thank you very much. Ajibola. I think that's a detailed answer, and that sort of addresses some of the concerns, that people have in terms of the directionality that the government is thinking around. I think, like you said, digital assets are assets, and you should pay taxes on your assets as far as you realize them. So we will pivot very quickly to the next question, which also is around something you mentioned. It relates to the oil and gas sector. You did mention the cleanups that have been done by the Finance Act 2023, including some of the changes that have been made around the oil and gas sector. And one of the questions that's been asked here is around the change or the removal of the restriction of capital allowance claims for midstream and downstream companies in the oil and gas sector. This previously, for the benefit of those listening, previously companies in those sectors could claim capital allowances, but there was an annual restriction of 66.67% of the capital allowances that they could claim in each year, which meant that significant capital investment, which has been made, would take longer than it should before it's recovered. And one of the questions that's been asked here is around the reasoning behind this change, and also what the impact is for the industry. How does this play out in relation to the Petroleum Industry Act and the transition to the Petroleum Industry Act?
Thank you very much. And that's a question that has also come up in some of my discussions with a few clients. If you think back to the framework that existed before the PIA, under the ACFA, all the old frameworks that applied to associated gas and incentives that were provided to the oil and gas industry to encourage them to begin to harness rather than simply burn the gas. And one of those frameworks was such that the capital expenditure that those companies incurred in bringing their gas fields into operation as an incentive, as an encouragement to the oil and gas industry, those companies were permitted to recover those expenditure against their upstream revenue. So in practice, nobody really was coming to SITA to come and claim capital allowances on gas assets. Everybody was claiming their capital allowances against and other recoveries against upstream revenue. But one of the implications of the PIA, of the Petroleum Industry Act, is the bifurcation and the application not only of hydrocarbon tax that applies to the upstream, but for gas operations, it has been clarified that gas operations will be taxable under SITA. Therefore, for the first time, you will then find that a number of oil companies who hitherto were taking their recovery against upstream revenue now have to be, in a sense, taking that against CIT. And if you then applied the CIT provisions as it were to those companies, they will fall into the non-excluded category where their capital allowance recovery was limited by law to the 6 2/3. So what the only companies that were exempted previously were very narrow manufacturing companies. So what the Finance Act has done is to expand the scope of exempted companies to include such companies. And logic is that the capital expenditure required to harness gas and bring it, and if you like, stream it in for utilization is so high that if you were to then peg the capital allowance recovery and their ability to recover their expenditure against their income, it will be a significant discouragement to those businesses. And Nigeria needs to see more investment in gas field operations. So what this law has done is to provide that succor to gas companies and the like, who are heavily capitalized industries, and allow them to recover their capital allowances. That's really the thinking behind it, I believe. And from my perspective, as a tax advisor, I mean, my clients love it because clearly a situation where they will not be able to recover their capital allowances was resulting in some of the models I had seen. It had resulted in them not achieving commercial viability of their financial models. So by the time you are going to a bank to go and raise capital and they look at your projections and they don't see you breaking even for the next 7 years, 8 years. I mean, how many banks are going to lend you money on the trust that, oh, you'll start paying back in 7, 8 years' time? Nobody's going to do that. So, but when they see that you have a throughput model where all your costs can be recovered against all your income, that gives significant encouragement and enables projects to achieve FIA, final investment approval, which allows more projects to come on stream in sooner than later. So for me, I think it's a good thing for the industry. And I hope that when the law does come into operation in September, we will see its impact in the increase in Nigeria's footprint in this area, which again would be another way of helping us to address our commitments under the climate change agenda. Because of course, reducing and eliminating gas flares would be a significant step towards achieving net zero, which former President Muhammadu Buhari had committed Nigeria to.
Okay, thank you very much for that answer, Ajibola. You know, just staying with this point, because the issue of investment in non-associated gas is one that industry is very interested in. As you speak and as I try to understand what you say, it seems as though the problem statement is the time within which these companies are able to recover their capital investment. But would you say that there are additional incentives, that are required within this industry to achieve the level of FID that you speak about? Because you look at other industries within the Nigerian sector, there are tax holidays that have been granted to those industries, for instance, and then there have been other incentives as well. So would you say that this industry, especially when you look at COP27 and Nigeria's commitment to net zero, would you say that this industry is one that requires significant, incentives, or are there other ways in which the government can stimulate the level of behavior that they want in that industry?
Well, sometimes you find that it's not a question of a silver bullet. You find that you have to use different approaches to achieve a desired outcome. Clearly, if you are going to remove an incentive this to oil and gas companies that encourages them to invest in gas gathering facilities, we're going to remove that incentive. At the very least, don't make their burden onerous. So already they can't recover their investment in gas against upstream revenue. Remember that in the pre-PIA regime, the tax rate was 85%. What that means is that if you are recovering your expenditure against a taxable income at 85%, that means that you're actually recovering up to 85% of your investment. Now, you then limit them to 30%. So firstly, they can only get back a fraction of what they were getting hitherto, 30% under the SITA rate. And then you then say to them, even that 30%, you can't take it all. You can only take a percentage of 30%. Look, we talk about tax having to be equitable, having to be fair. The regime that we have used since 1958 has been one where I can recover my expenditure against tax of 85%. And then overnight, because of PIA, and telling me that I should separate everything out, tax the midstream according to the SITA rate, tax the downstream at a different rate, tax the upstream at the hydrocarbon tax rate and the SITA rate as well. Once you've then bifurcated everything, I then wake up the morning after and I can only recover a fraction of my expenditure. Why then would I make the expenditure right? So you first have to be fair to people. Okay, you've lost your 85% recovery, but at least take your 30% recovery. That's the first step. Now, having resolved that one, you then have to look at the other things that are happening in that industry that discourages investments. For example, when you say supply gas, who are the users of gas in Nigeria today? You will find that is the electricity generation companies. You then say supply gas to the gencos so that they can generate power. But the price at which you supply that power is controlled by the government, and it's not the commercial price that you can get if we were to say sell that gas to a willing buyer in another country, for example, at an international benchmark rate. So I can't sell my gas when I gather them at a commercial rate. I must sell at a rate that you dictate. I cannot recover my expenditure beyond X percentage. I mean, I think a lot more work has to be done in this area. Thankfully, we have people at the helm of affairs, either in the upstream regulatory agency or the downstream regulatory agency, including people sitting with the president in the executive, advising on petroleum matters, who are experts in gas. And I expect that over the next few months, these experts will convene a roundtable with operators in the industry and hopefully, fashion out a course of activity that leads to increased investment in this area, which can also benefit Nigeria, because ultimately Nigeria will be the net beneficiary if we see more activity in this area. It's an area where we can achieve some low-hanging fruits, if you ask me. But the work has got to be done. So yes, it's a good thing that's been done, but it's not a silver bullet. A lot more still has to be done in order to foster an operating environment in which the gas industry can thrive in Nigeria. I hope that answers your question, Doke.
It does. So that was my question. So still talking about the oil and gas industry, because this is an area that I believe interests quite a lot of people. And then you're talking about the environment and the impact of the oil and gas industry on the environment, gas flaring and the ability to capture non-associated gas. A similar issue, not exactly in the same remit, but there's also the subject of decommissioning and abandonment, right? Which is a critical area of the work that's done by the oil and gas industry in restoring the environment. And one of the changes that have been made in this year's Finance Act, the PPTA, is to resolve the long-standing controversy around the possibility of decommissioning and abandonment fund for upstream and midstream oil and gas companies. So our guest or our audience is asking, how does this amendment really achieve this? What was really the issue, and why was this change, necessitated, and why was it necessary?
Okay, well, this is a matter that has been that KPMG has actually expressed very strong views on in our impact analysis on the Finance Act, which was published a few weeks ago. So I'd encourage our readers, our viewers, to please obtain a copy of that. You can download it online on our website. It goes into a lot of these details. In regard to the decommissioning expenses in particular, the amendments to the Finance Act resolved a long-standing controversy between the oil industry and the tax administrator around the kind of costs that can be recovered by those operators around decommissioning. Of course, let me try and explain what decommissioning is. Decommissioning is what companies have to do at the end of the life of a well. So you have, let's say you drilled a well in a particular location and you have been evacuating crude out of that location for a number of years. So what typically happens is that every year the oil companies make a provision in their books that is put aside towards eventual decommissioning of that well at the end of its operations. And then the question then arises, what do you do with that provision? And of course, the tax authority view had been that to the extent that the provision is unfunded, in other words, if it's not a contribution, if it's just an accounting provision, then you have not incurred any expenditure, and so you should not take a tax benefit for an expenditure you have not incurred. The tax industry view had been, and also of course the IOC view, had been that, look, these decommissioning expenses can be quite large, as you would imagine. You have to clean up the environment, you have to seal up the well. The number of remedial, it's usually extremely expensive. And of course, that argument had lingered. What this amendment has done is to clarify it, if you like. So now the provision has to be contributed. So in other words, there will be an outflow of economic benefits towards providing for the eventual decommissioning. And there's now a lot of harmony between the tax law and the PIA in relation to decommissioning. And I think this helps the industry. And it also makes it clear that decommissioning costs will be permissible as a tax deduction. You can get more details from our impact analysis handbook, which I recommend to everyone.
Okay, thank you very much, Ajibola. So very quickly, we'll move to, I think we spent quite a lot of time on the oil and gas industry. So I think we should pivot very quickly to one of the comments you made, during your initial remarks, around the import levy that has recently been introduced on all eligible goods imported into Nigeria from outside Africa. And, the rationale for this change is that the revenues from this tax is intended to finance capital contributions and subscriptions and other financial obligations to the AU, the ADB, and the Afrexim, ECOWAS, and the likes. There's a question here which is asking what the economic implications of such a policy is. Again, Nigeria is a very import-dependent country. The cost of these levies ultimately affected pricing of the products, increases the cost of importation, and would likely, affect the price of commodities, and that has its impacts on inflation and whatnot. So I guess what this person is asking, what really is the potential implication of this policy? Is this a step in the right direction? Is it possible that other, countries, non-African countries would retaliate? And how does this really play out in view of the, continental free trade agreement?
Thank you very much, Kuke. But before I respond to that question, in wrapping up on the oil and gas industry provisions in the Finance Act, there are other changes made in the Act, for example, aligning the tax legislation with the PIA. So for example, you find that the agencies have been created by the PIA, for example, the NUPRC, is not named in the tax legislation. So there were consequential amendments made in there to align, to name those entities, to just make sure that everything works in sync, and also to align the penalties between, and update the penalties, if you like. On the whole, I think the changes made to the tax framework applicable to oil and gas companies has been beneficial. There was also inclusion of definitions, for example, of fiscal price for crude oil, for revenue recognition, which addressed an academic problem that had arisen in relation to the hitherto use of reference to posted price. So, but those are changes that were made to be complementary and to, if you like, clean things up, which is one of the objectives of an annual Finance Act, to clean up the tax legislation and make it user-friendly. So I think the Finance Act of 2023 did try to clean up the tax provisions applicable to the oil and gas industry and make it more user-friendly. Now, you then remark on the import tariffs designed to help Nigeria finance its obligations to multilateral agencies. We do know that Nigeria is suffering a significant debt overhang right now, and the country is in dire needs of finances. But if you were to, to be completely honest about this, this is probably one of the provisions in the Finance Act that I personally cannot justify. And I hope it will be reviewed. Now, suspending the legislation does not review it, because the legislation will come into effect again on 1st of September 2023. So if we really want to address this, then I would encourage the OPS, the Organized Private Sector, and the Manufacturing Association of Nigeria in particular, to lobby, to engage with our representatives in the National Assembly and propose an amendment. We do recognize that the government needs finances. There's no gainsaying that. And I believe that, look, we must have a country first before we start having an economy. Because if you don't have a country, if you don't have a government that's functional, that can pay its debts, you won't even have anything. You won't have an organized market. But at the same time, you can't kill the goose that lay the golden egg. This country's economy is being fired on by the hard work being done by manufacturers, by traders, and you are right, Nigeria imports a lot of our consumption is imported. So the implication of this duty is going to be, if you like, cost inflation. You're going to have an increase in the price of goods, also potentially services. So can it be avoided? Can it be mitigated? I don't know, but I would encourage the organized private sector to engage with the government. And thankfully, the government of President Bola Ahmed Tinubu has shown that they are listening, they are sensitive. To have even deferred the commencement of the Finance Act till September 2023 in itself shows that President Tinubu is sensitive to these matters and is listening to what the business community is saying. So I encourage the business community to engage to see if this can be reviewed. As to whether there will be backlash of other countries also adopting similar protocols, I guess any country can adopt whatever policy or protocol they believe will enable the economy to thrive. But for me, Nigerian businesses are already carrying so much burdens. Increasing the burden on them by the imposition of this levy, I hope it is reviewed. I think I'd rather leave it at that. Thank you.
Thank you very much. You said so much without saying too much. And I think the message is loud and clear. Clearly, there's a need to take a second look at that provision to ensure fiscal equity, like you said. So still on duties, one of the changes made to the Finance Act of 2023 is around the provision of excise on service. Last year, the Finance Act introduced this new provision, which seeks to apply excise, or which sought to apply excise on services and telecom services specifically. This year that provision has been modified, and it seems to replace telecommunication services with a broader base, which is all services. And so that raises a question, which is, what exactly is the intent of this change? What is this change targeted at? What are the kind of services that this change is looking to tax? And then also, does this then mean that the telecom sector is now out of scope? So that's the question that's been asked to you. So I'll just take your response.
It's an interesting question. And of course, we do know that the telecom sector is probably one of the more successful sectors, even though they do have their own challenges as well. But it's at least one sector where almost every Nigerian is affected. We all purchase telecoms services. And in a sense, this seminar in itself, this social media chat, is being facilitated by the telecom sector by providing us with the bandwidth with which to communicate with everyone. So any change in that sector directly affects your pocket and my pocket. So if you add 5% excess levy on telecom sector, obviously you expect that the telecoms operators are going to simply pass that cost on, because their margins are, well, I'm not arguing on their behalf, but we all know that their margins are not that robust, right? If you take a survey of the companies in the telecom sector and how many of them are profitable, I think you will begin to see the sense of the direction in which I'm traveling when I say that they can ill afford to absorb that tax, that levy. It will be passed on to the ultimate customer. And if it is passed on to you and I, that means that we can expect an increment in the charges we pay for these services. Now, can we afford it? Can we not? Maybe the government palliative that's coming will enable us to be so rich that we can increase our consumption a little bit. But having said that, the idea behind the legislation this year, I think, reading through those provisions, it's clear to me that the intention was to let everyone know that the entirety of services can now be included for excise duty, not just telecoms. You know, hitherto last year, we were having this debate around why focus only on telecom services? What about other services? I mean, this sector, why is everyone so fixated on telecommunications? So in a perverse sense, I think, maybe someone heard you, maybe God heard us, and then revealed to the fiscal planners, guys, why focus only on telecoms? Why not other professional? Why not other services? So, okay, I make you a bet that when the president finally issues regulations around services, professional services, watch out. Laundry services, watch out. Grocery services. So all services are now in scope. So we now have to wait for the president, because ultimately the incidence of the duty has got to be determined by the president and issued as an executive order, if you like, as a tariff. So the president has been given power to determine the rates and determine the services that it will apply to. Thankfully, the president has already told us that he has suspended the application of the tariff on telecoms, which was the initial subject of that tariff. So that has been suspended, which means that you and I can continue to purchase telecom services and purchase data from telecoms operators without paying more, thankfully. Now, whether that will be suspended completely or will be introduced at a future time or not, we'll have to wait and see what the president's thoughts are around that matter. But for other services, we again have to wait and see. So, and that's why the question must go beyond suspending the Finance Act of 2023. Are we also going to see a lobby for amendments of some of its provisions? For example, now that we know that all services are in scope of duty, is there a view that services should be completely excluded and duty should only be on goods? I mean, the totality of an economy is not just goods, it's also goods and services. So should we impose the duty on services? Let's have that debate. The Finance Act has said, yes, it should be. But let's engage with the president and let's try and help shape his thoughts around where to go on this matter. I think he's been given a broad discretion and a broad scope within which to operate. And it'll be interesting to see how that discretion is then exercised.
Thank you very much, Ajibola.
So are you willing to pay more though? Do you want to pay more for telecom services?
I mean, I already pay quite a lot, so let's just leave it at that. And I was going to say, the president has already made it clear, his intention to let the poor breathe. So clearly, let's hope that professional services will not, be targeted. I wouldn't put us in category of luxury like the telecom services. So thank you very much for that response, Ajibola. Very quickly, we will take the poll. So very shortly, you would have the QR code pop up on the screen. For those people who have their phones, you could quickly scan the QR code and respond to the questions which we'll be asking. The questions are very important to help us understand the implications of the Finance Act from your perspective and to help us understand your pain points. It also helps in the conversations we will have internally within KPMG and also with stakeholders about changes which companies would like to see. So the QR code is up on the screen now. Alternatively, there's a link at the bottom of the screen, so you could input that on your web browser, and that takes you straight to the poll, and you can respond to questions very quickly. Thank you very much for your support. Thank you very much.
While we take the poll, someone just sent me a message, interestingly, indicating that financial services, are we also going to expect the duty on financial services? We already pay the highest interest rates in the world, according to this message. We're already paying the highest interest rates in the world. So if we're going to also include financial services in scope of this service levy, then we're going to be paying even more.
Okay, thank you very much. I see the responses have started to come up on the screen. The first question, what sector of the economy are you from? This gives us an understanding of the audience and the sectors they represent. We have 13, okay, it's changing, so I'll give you a few minutes. But, it seems quite a lot of our audience are these three sectors. Okay, it seems the numbers are beginning to take shape. We have a small representation from the telecom sector, about 3% of the audience. Over 50% of the audience are from other sectors. I imagine we have quite a lot of tax professionals, a lot of students. We have people from the IT sector as well, considering the changes and implications we have on that sector. We also have about 25% or thereabout from the banks and other financial institutions. About 18% of the audience is from the oil and gas sector. So we do have a heavy representation. I can see quite a number of people have not taken the poll. So please, if you can, please join the poll so we have a more accurate representation of the persons in attendance. Okay, so we're on to the next question. What industry do you think is most affected by the Finance Act of 2023? So currently we can see quite a lot of people think that the oil and gas sector is very heavily affected. I would imagine that that's because of the kind of conversations we've had, because we've delved quite nicely into the changes in Finance Act that affect the oil and gas sector. We can also see quite a lot of people think the telecom sector is affected as well. There's also about 2% of the audience that think the shipping and air sector is affected as well. So we'll just give people time to put in their results, and then we'll read the results. Okay, 73% of the audience thinks that the oil and gas sector is the most affected. 12% think the telecom sector is affected as well. We have about 12% of the audience that think other sectors of the economy is affected. And there's a small percentage that thinks that, the shipping and air sector is affected. It'll be interesting to, get some questions or some comments around that from the persons in the audience who have that view. It'll be interesting to see what your pain points are and what the clarifications you need will be. So we're on to the next question now. The next question is around the investment allowance. The question is the phase out of the investment allowance a positive step in streamlining tax expenses in Nigeria? This is a straightforward yes or no question. Quite a lot of people so far, about 33%, and about 33 people in the crowd have voted, and 66% of those believe that it is not a positive step. It'll be interesting to delve into why that is. I think it's quite clear that it results in additional tax payments for companies, especially in the manufacturing sector, where there's quite a lot of investment in plant and machinery. So it'll be useful to understand, why that has been taken out. We'll probably discuss that as we go ahead.
Well, you might start by asking yourself what parts of Nigeria would you consider to be non-rural? What part would you say is developed? Or is there not a case for saying that the entire country has degenerated into such a bad state that we are all, in a sense, in need of urgent investment? So if you are, why then would you select one or two areas over and above others? That's one way of looking at it. So should this incentive be streamlined and made available to all investors, regardless of where you invest anyway? Many companies have to provide their own power wherever they are. Many companies have to fix the roads leading to their factories. Why should they not be able to get an investment allowance wherever they are? Why limit it only to those who are in rural communities? And what really is the rural community in Nigeria of today? Perhaps that's the next level.
Absolutely, I agree with you. I think the rural investment allowance was due to be, expunged. I'm not quite sure there are lots of companies who are taking advantage of that. There were some, but then the law only provided for recovery of about 30% of your costs, which again did not, it wasn't very attractive, when compared to schemes like the Road Infrastructure Tax Credit Scheme, for instance, where you could construct a road in an economically disadvantaged area, and then you could get full recovery of your cost of building that road project plus an uplift, which is equal to MPR plus %. And then you could also recover your tax credits within the same year, if you were to invest in an economically disadvantaged area.
It gives you your money back. 100% of your money back.
Yeah.
So I think we need to move past static, if you like, dumb incentives to business and start using sensitive strategic incentives that actually puts money in the pockets of investors.
I absolutely agree with you. Absolutely agree. And just to take us back, the last question that was asked around the investment allowance, there are two changes. There's the rural investment allowance, and then there's the investment allowance of 10% on plant and equipment. And I think that's probably one of the concerns the respondees had. And the results, 74% of the audience believe that it was not a good change, and 26% thought it was a positive change. So we've moved on to the next poll question now. And this question is around the tertiary education tax. And essentially what we're asking here is whether we agree or we think that the TET rate increase from 2.5% to 3% will significantly improve the funding of tertiary education in Nigeria. And initial results are that 63%, over 63% of the audience believe that it will not. So that perhaps is perhaps due to the trust gap between the federal government and the citizenry. Or yes, it could also be perhaps due to more critical points around whether this is even sufficient, whether the marginal increase is even sufficient enough to finance tertiary education, as things stand today, considering the inflation and whatnot. So it's an interesting point. Okay, so while we take the poll questions, and there are quite a lot of questions which I think we can use the opportunity to ask. So Ajibola, if you don't mind, I'll just ask you some of these questions. A lot of the questions here around things you've already spoken about. So perhaps maybe the respondees want additional insight.
Yeah, let's go ahead.
Okay, so there's a question here that says, with the removal of subsidy on petrol and the energy transition, do you think there's space in the Finance Act 2024 for removal of 35% duty or 35% levy on electric cars and plug in hybrids of range of 30 kilometers plus? So I'll read the question again. With the removal of subsidy on petrol and energy transition, do you think there's a place in the next Finance Act, that is Finance Act 2024, for removal of 35% duty and or 35% levy on electric vehicles and plug-in hybrids of range of 30 kilometers plus?
Well, a lot has happened in Nigeria between May 29th and today that the planners of the economy will have to take into consideration in designing what hopefully will be a continuation of the tradition around the issuance of finance bills and legislation to stimulate the economy and provide for incremental changes to the tax environment and other fiscal environment, because it's not only about tax, other aspects also come into play when designing the Finance Act. The removal of petrol subsidies is one key one. Now, if you think back on Finance Act 23 and also the special fiscal measures that were adopted by the Minister for Finance in around April of 2023, there were changes made to the duty regime applicable to motor vehicles, if you recall. And now we also have other, if you like, fiscal matters that have arisen, withdrawal of petroleum subsidies, for example, which is really, taking biting a hole in the wallet of most Nigerians at the moment. I imagine that the planners will have to think through what this means for the economy. We've been expecting a spike in inflation as a result of if you just think about it, with the increase in with the withdrawal of petrol subsidies, one would expect there will be an increase in transportation costs. And transportation costs is a key element of the basket of goods and services that are measured in determining the inflation rate in Nigeria. So you won't see a spike in such costs without also seeing a negative impact on inflation. And so if there's a negative impact on inflation, one of the key things that the monetary policy experts try to do is to moderate inflation, target inflation. And of course, Nigeria has had the Hydra-headed task of having to target inflation while at the same time target exchange rate stability. So these are going to be very difficult conversations, I think, that the monetary policy handlers and the fiscal policy handlers are going to have to harmonize their thoughts around and see how they can keep the ship afloat. It's going to be a very careful, sensitive act. But I hope that the tradition that has prevailed over the last 4 years will continue to prevail. And it is in this light that one must say that the president has already constituted a presidential committee on taxation and other fiscal matters. And that is a very good step in the right direction. It tells me, and I hope it tells our audience, that we are likely going to see a continuation of the discipline of thinking through what changes are occurring in the economy and utilizing a legislation like the Finance Act, amongst other initiatives, to try to move things along. When you look at the kind of people who have been appointed, at least the chairman of that committee, these are seasoned experts. He's a very seasoned person. And I have no doubt that with the president, who is very keen to see positive changes in the tax space, with an energized private sector that is affected by these changes and will engage positively with the government around what makes sense, what doesn't make sense. I mean, yeah, we're going to feel the pinch, right? But if you can also see what the net positive impact is overall, sometimes you're willing to take the pinch. I think people start complaining when they're feeling the pinch and they don't see any, there's no indication that there's sunlight at the end of the tunnel. That's when you start complaining. So I think the signals we're seeing are such that we would expect that tradition to continue. To answer your question specifically, Goke, I think the tradition will continue. And I think that the planners will harmonize. Right now, all these threats are disparate, and there's obviously a need to bring them all together, bring everybody into the same room, and let them hammer out a path forward.
Thank you very much, Ajibola. I think the answer is clear. The signaling is positive. Engagement is key. So private sector engagement is very necessary. So it's important that we all get involved in our different capacities to see how much change we are capable of influencing. And I think KPMG platforms like this is a useful avenue for you to, bring your thoughts to public consciousness. The next question here, which speaks to something you had touched on earlier, is around the legality of digital assets. So the question here is, please clarify what the status of legality of digital assets is. We are aware that the government was clamping down on people involved in crypto. How will the government now want to tax what they class as illegal activities? What they class as illegal activities? I think Ajibola had tried to answer this earlier, when he tried to explain that, taxation and morality are in two separate buckets. And so the morality of your income stream does not necessarily impact on the tax. And then he made the point that it's important that, the monetary policy side and the fiscal policy side have a sit down and then agree on a direction. So I think that question has been answered. But if
I'd like to add one more to that though, which is that I'm not aware of any law today that criminalizes trading in cryptocurrency. There's no such law. The central bank is not a lawmaker, and they also did not make such trade a criminal activity. All the directed banks to not do is lend their banking platforms in aid of such trade. Now, so that doesn't necessarily make it a criminal activity or an illegal activity. But having said that, even if it were illegal activity, it really shouldn't matter. If you have income, you have to pay tax on your income. And we've seen examples from other countries of even mafia lords that have been indicted for tax evasion, and where the US was not able to prove that they were involved in criminal activity, they were at least able to prove that the individuals had income that they had not paid tax on. So it really wouldn't matter what the activities are that generated the revenue. If you have income, you should pay tax on it. So, but in relation to cryptocurrency and digital assets, trading in them is not illegal in Nigeria. The police will not arrest you if you engage in crypto trade. It's not illegal. But the central bank will not allow you to, trade your proceeds through the banking system, which also then leads to an interesting question. If we're going to tax the revenue arising from such trade, in what currency will the tax be paid? Will the tax be paid in regular currency, Naira and Kobo, since central bank will not allow us access to banks? Or will it be paid in also digital assets? So will FRS open a trading wallet? I know a number of exchanges here would like to have FRS as their customer. Let FRS go and open a digital asset wallet and start transacting there if they want to collect taxes. But I mean, that's in the lighter mood, of course. But I think you will find that the monetary policy handlers and the fiscal policy handlers, including the FRS and the Ministry of Finance, will have a sit down and resolve these issues sooner than later.
Thank you very much. And just to add to that, I think you didn't make, as it's an interesting question across my mind, around what currency the tax is paid in. The second question that then comes to mind is, at what point do you treat the asset as realized? Because there are quite a lot of crypto exchanges where you're selling one type of cryptocurrency for another. And ultimately, you could argue that cryptocurrency is cash. There's that debate around the world as to whether it's a security that should be regulated by the Securities and Exchange Commission, or if it is indeed a currency or a legal tender in its own right. In some countries have adopted Bitcoin, for instance, as their legal tender. So the question is, at what point do you say the asset is realized? If I was to sell Bitcoin or Ethereum, have I really made a chargeable gain? Have I realized the asset? I think there will be questions around that will come up.
And especially around volatile assets like that, where we've seen serious spikes in valuation. So, and on a happy note, of course, the Finance Act of 2023 also includes provisions allowing us, for the first time ever, to actually take a deduction around our losses, our capital losses, against our capital gains. So hitherto, if I take crypto as an example, hitherto, if you are trading in Bitcoin and you make, let's say you have a portfolio of 1,000 coins and you make profit on only 10% of your sales, and for 90% of your holdings, you have suffered a loss, because we all know that there was a recent downward spiral in Bitcoin valuation. Under Nigerian laws, as of today, since the act is suspended, you cannot take a deduction for your losses, but you will still have to pay a capital gains tax on your profits. So if I only made a gain on 10% of my holdings and I made a loss on 90% of my holdings, the taxman will say, I don't care about that loss, but come and pay tax on your profits. I mean, that's unfair, right? So again, in furtherance of fiscal equity, the Finance Act of 2023 allows us to take our losses and only pay tax on a net profit basis. And that's a very good thing. And I'm hopeful that by September, when this kicks in, you're going to begin to see its application, not only around digital assets, also around, say, for example, shares and stock on the capital, on the stock exchange, and so on and so forth, landed property, and all the other instances of chargeable assets that will now be able to take our losses against our gains. And where there's a net loss, we can actually carry it forward for upwards of 5 years. So I think there were a number of very salutary and commendable provisions in the Finance Act that we're hopeful will come into play. Now, there are people that have adopted those provisions as of June of 2023 in the filings that they had made to the tax authority. And now that it has been deferred till September, question would be, what happens to the positions you took in June? Were they wrong? Do you need to file an updated tax return? Or do you say that, I mean, what really happens really? Do you need to stay with your position and wait for an FRS audit? Or do you need to proactively file an updated return reversing the positions you had earlier taken? So those are the kind of matters one needs to start discussing with your tax advisors and obtaining some insight as to the appropriate way forward.
Thank you very much, Ajibola. I think the protocols around filing updated returns, complicates the process. So that again is an issue that has to be dealt with. But thank you very much for that, and I think you've done justice, more than justice to the question. There's a question here, asking you to shed more light on the sector of downstream, upstream, and midstream in the oil and gas sector. My interpretation of this question is this participant would like you to expand on the changes made to the data around capital allowance claims for companies in the upstream, midstream, and downstream sector.
Well, there's been no change really in what you can claim as capital allowances. The law is still clear as to what a qualifying asset is for capital allowance purposes. There's no change in the manner in which you will compute those capital allowances under the Companies Income Tax Act. The only change had been in the schedule that had limited your ability to recover those capital allowances against your income for that year. And the change had been to remove the limitation on your ability to recover. So I hope that answers the question properly.
Thank you very much. Okay. So the next question here is still, we're just trying to walk through. There are quite a lot of questions on the oil and gas industry in the question box. There's a question here that says, they want a brief recap of the implications of the new PIA, especially with the new tax rates in the upstream sector. That's quite a broad question. I don't know if Ajibola would like to take a quick stab.
Yeah, that'll take us another 30 to 40 minutes. So we'll probably have to schedule another chat where we can actually, take the PIA and break it down for people to understand. But pending when we do that, I'd also invite the questioner to please go to our website and download our commentary on the Petroleum Industry Act. It does provide insights into the very important question that you have asked. We will have a session to discuss it, but until we do so, you can avail yourself of our thoughts on the subject by downloading that material. It's free. Just go to our website and download the material.
Okay, thank you very much. Just to re-echo Ajibola's comments, the PI is a broad legislation. In comparison with the PPT, you're looking strictly at the fiscals. and there's the overhaul of the fiscal regime for companies in the sector. There's the introduction of the hydrocarbon tax, and now there's a requirement for companies that engage in oil production and exploration to pay CIT. So it's very broad, like Ajibola has said. There'll be a need. KPMG has done quite a lot of engagement prior to the enactment of the legislation and after the enactment of the legislation. And we have quite a lot of material available online in case you would like to, read through for more understanding. The next question here also has to do with the PI and the PPT. So we will just, we'll walk through them. There's a question here around how the Finance Act 2023 encourages agriculture in Nigeria. I'm not certain there are any changes specific to the agri sector, but it's very possible that some of the changes in the Act would invariably impact the agri sector. Off the top of my head, I can see how, the import levy may have some implications for that sector. It could potentially encourage, investments in the agri sector, local production. There may be a few other that also impact the sector. So I'll just let Ajibola take a stab.
I think you're correct. There's no direct implication for the agri industry in any of the provisions of the Finance Act. But when you look at the special fiscal measures enunciated and the adjustments made to the import tariffs, you will see that some equipment have received beneficial adjustment to the duty framework applicable to them. So, and when I looked through some of them were actually machinery and other items included in the agri value chain. So the devil is always in the detail. So I would encourage everyone to take a look at those tariff adjustments. They were also suspended by the president till September of 2023, so they don't kick in quite yet. But it's important that we all familiarize ourselves with that duty framework, and if there are aspects of it that are beneficial to our business for those in the agri value chain, we should take advantage of them.
Okay, thank you very much. There's a comment here, and I'll read this, quite a lengthy comment, but I think it's very interesting. So it says, assessing services to excise duty seems odd. Looking at the definition or description of excise duty, it is charged on manufacture of certain goods. Essentially, excise is charged on locally manufactured goods as against import duty on imported goods. It says in many other instances, the duty is to discourage consumption of certain categories of goods. It will seem very odd to seek to apply to services. If the government is seeking to raise additional revenue, perhaps VAT should just be increased so that we can know where we are going. Happy to have your thoughts. So just to summarize, this participant is basically saying that excise duties, by the very definition, should be targeted at goods and should be targeted particularly at locally manufactured and certain imported goods, which are harmful to discourage consumption of such goods. And the participant is also recommending, replacing the excise duty with VAT. So would like to get your thoughts on that.
And from a strategy perspective, and also if you don't want the country to continue to be a dumping ground for imported goods, you have to start distinguishing between tariffs that apply to imported goods and those that apply to locally manufactured goods. For example, why should the same excise tariff apply to a product, whether it is produced locally or imported? What then is the incentive to a manufacturer to come and produce locally, other than maybe better proximity to the market? So I think we and that's what I was referencing earlier when I said that we need to start making some of our tax systems sensitive to our economy, where they actually drive the kind of behavior we want. So you use discriminatory tax tariffs to protect local industry and ensure, without breaching the WTO accords, of course, because there are rules under the WTO as to what you can do to protect your local industry and what you must do to allow open access. But with all due respect to all that, there's a place where you say, for example, that if you are bringing a product out of, from outside of the country, I'm going to apply this excise duty to you. But if you are producing locally, either I tax you at a lower rate or I exclude it altogether. And that's something one might think of. Now, but to the actual question that was raised, it will sound a bit counterintuitive to me to complain about an imposition of excise duty while at the same time campaigning for an increase in VAT rates. Ultimately, it leads to the same results, isn't it? Which is an increment in the tax burden on the taxpayer. But having said that, it is also a fact that at 7.5%, Nigeria does have one of the lowest VAT rates, even if you compared among our peer countries in Africa. In Ghana next door, it's more than double what we charge in Nigeria. And in South Africa, for example, again, it's more than double. So I would say that, yeah, there's headroom for increasing the VAT rate, but that's in theory. In reality, you have to look at the impact of that increase in VAT rates on the basket of goods and services that are traded within our economy. What is the ability of the Nigerian to pay that rate? And you might then find that an incremental, the government had signaled a desire to adjust this incrementally, and we saw an increase from 5 to 7.5%. There was some wisdom in doing it incrementally. Should we now in one fell swoop jump to 18%? I would think that would be damaging. It might very well be that we do so incrementally. There is also wisdom in sensitively deciding which aspect of the economy is better able to absorb it. So maybe rather than a blanket increase of VAT rates to X%, you may find that we have differing VAT rates for certain sectors of the economy that can actually take it. That's the direction of travel we haven't used before, but it's one that I think you may find some support in Nigerians. There are some areas of our economy that are better able to absorb an increase in VAT rates, and there are aspects of the economy where they cannot absorb it. So we need to have that dialogue, and I'm hoping that the planners of the economy over the next 4 years will be able to leverage their insights to identify those areas where, if you like, to a path of least resistance. What aspects of the economy would actually not object to such moves, not only across VAT, also across other tax heads. But we should also be careful to not use tax the way we're using it currently, as a dumb or blind instrument that applies to everybody regardless of their circumstances. I could go on, but I think I'll pause at that point.
Okay, thank you very much, Ajibola. That's a very detailed answer. In the interest of time, we'll move very quickly. There's a very interesting question here, which is around the effective date of implementation of the Finance Act 2023. And the question is, based on effective date of September 1st, 2023, for Finance Act 2023, how is the education tax payable for 2024 year of assessment calculated? Do we get prorate financial information from January to August 2023 by 2.5% of assessable profits, and the remaining months by 3% of assessable profit? Over to you, Ajibola.
Well, I'm thinking ACUGAS versus FRS. I'm thinking a number of different cases decided by the TAT on the subject of applicability of tax legislation. We know that taxes should apply not retrospectively. And so in theory, I can sympathize with the questioner who is thinking, what I need to do is take my sales for the year, my revenue for the year, apportion and apply two tax rates: the tax rate before the commencement date and the tax rate after the commencement date. I've also heard an argument that you've got to take the law that applies on the day you are filing. So if you look at the FRS guideline that came out after the Finance Act was issued in 2023, they did clarify that it would apply to companies with year end after a particular date. So in other words, if your year end falls after that date, just apply the 3%, the totality of your assessable profit, on the premise that there is only one assessable profit per filing season. You don't have an assessable profit every month. You only have one assessable profit. And so you apply the TET rate applicable to financial year end, ending after, now that it has been suspended till 1st of September 2023, I would assume ending after 1st September 2023. That, I assume, would be the FRS position. And there is some merit in that position. But I also think that September is so far in the year that there is a basis for evaluating other options. Would it be fair to then say to a company that has traded on the basis of 2.5% being the applicable rate, and then you come to them in September, October, and then say to them, oh, your rate is now 3%. Would that be fair? I guess that's a conversation we will have and get answers. Hopefully, the FRS would also publish, if you like, guidelines that can guide the industry. My personal view is that we should take a position that makes sense to everybody concerned. And if prorating makes sense, then we should prorate.
Thank you very much. So, I mean, like Ajibola has said, you know, it would ultimately depend on your industry. It will ultimately also depend on the nature of the activities and and how you choose to interpret the law. So if you do have this as a practical issue which is bothering you, please feel free to reach out to us after this session. I'll be happy to help solve your problems, or at least try to, you know. So the next question here, again on cryptocurrency, and it seems this is quite an interesting issue for a lot of people. You know, we've talked about the CGT issues, the CIT issues, you know, the diversity around that. Now, the question here is, you know, the questionnaire is asking if we can shed a bit more light on the transaction taxes around trading of crypto, especially VAT. Now, I'll try to take a quick stab at this just to help, and then I'll let the Grandmaster, you know, step in.
So by all means, steal my thunder. I mean, you're quite a capable tax advisor yourself, so how about it?
So I mean, for VAT, I mean, if you look at the charging provision of the VAT Act, it's quite clear. It's applicable to taxable supplies, taxable goods and services. The law defines taxable goods, and it's very specific in the definition to exempt money and securities. And so what you find is if you are to make a transaction or continue a transaction that involves exchange of money, or exchange of foreign currency, or exchange of securities, then VAT would typically not apply. So, you know, it follows therefore that in the case of cryptocurrency, VAT will not apply on the disposal of cryptocurrency to the extent that you classify it as money or securities. But the interesting thing is cryptocurrencies are still, or digital assets are still interesting in their composition. That you can talk about cryptocurrency on one hand, and on the other hand, you can talk about NFTs, which some people would classify as artwork, right? And then you then go into the you know, premise or the framework of, you know, taxation of art pieces and whatnot. And you may argue in that case that VAT would apply, but that's complicating the argument. I think keeping it simple, you would look at it as securities on which VAT should not apply. But I'll let Ajibola comment on that.
I mean, you go to the head of the class immediately. I mean, clearly that's the right way to look at this. Okay, I'll just add that beyond the actual trade, remember the trade is facilitated by exchanges. You're not. I mean, even though you're dealing peer to peer, there is always an intermediary involved, and of course, just like banking, right? So you don't pay VAT on money or securities, but when you go through an intermediary, a bank, a stockbroker, there will be fees chargeable, right? And there will be VAT on those fees. So when you are walking through an exchange, the exchange itself, especially under the current VAT, I mean, rules issued by the FRS, the exchange should register for VAT and, add VAT to its charges. You also have custodians, people who hold those assets in their, you don't keep your wallet in your house, right? It's an electronic digital wallet, right? So there are also custodians of those digital assets who hold them on your behalf, and then they issue you with security keys. So there are a lot of services across the value chain that have to be identified and appropriately evaluated vis-a-vis whether they fall into the VAT sphere or not. But in terms of the actual trade itself, yes, Goke has already answered correctly that those matters should ordinarily not be exposed to VAT.
Thank you very much. Glad I was able to at least some justice question. So we'll move very quickly. We're short of time. I think we have 15 to 18 minutes left. We have quite a lot of questions to run through. So permit me, because I might have to summarize some of the questions. There's a question here on deferred annuity. I believe this is from the insurance sector. And basically, the question is, how practical is the 5-year minimum holding period around this? In the case where, there's an early withdrawal, how will the tax be implemented? Just a bit of background around the question. There's been a reintroduction of the tax deductibility that's applicable for premiums paid in respect of the contract of deferred annuity. But there's a caveat that in order to enjoy that tax deductibility, there must be a minimum holding period of 5 years within which you're allowed to keep those premiums before you make a withdrawal. So the question here, again, just to summarize, is what is the practicality of this? What exactly is the deferred annuity, and how would the state tax authorities track withdrawal, collect tax?
Well, it also hankers back to the mischief that drove the regulator to withdraw the provision in the first place. It's been restored partly or somewhat, but there was a reason why it was taken away in the first place, which is that we had abuse in the system. We had reports of individuals who apparently, I don't know anyone who's done this, but the tax authority felt that there was sufficient incidents of fraud where people would take 100% of their pay and use it to purchase annuities, not with a view to purchasing annuities really, but with a view to obtaining tax exemption on their income, and then turn around the next month and cash out on the annuity. So it was seen as a tax evasion scheme, and that's why it was taken out. Of course, that then had the impact of crippling the entire industry so far as that product was concerned. The product simply disappeared. And so that amounted to punishing the innocent along with the guilty, if you like. And after we all appealed and showed the regulatory reason why that may have been excessive, they have thankfully returned the product. And so companies can now issue those products. So I think the halfway house, the provision you are saying there is designed to sift between the wheat and the chaff, such that if you are truly purchasing an annuity, you would hold it for the long term. And long term here being seen as anything higher than 5 years. If you then liquidate or exit from that position within 5 years, then any tax benefit you obtained from that deduction could be rolled back, and then you pay tax on it. That is my understanding of what the taxman is trying to achieve here. And to the extent that the product is back, I know that the insurance industry is very happy with this provision. They are looking forward to, seeing an increase in the number of products that are issued by operators. And so to that extent, we say thank you, and we look forward to September when the provisions will kick in.
Thank you very much, Ajibola. I think that's a very detailed answer. very much appreciated. The next question is around the shipping and air transport sector, and this is an area where we've been clamoring for questions. So the question here is, the Finance Act 2023 mandates the regulatory industry in the shipping and air transport sector to request income tax filing and TPC from companies taxable under Section 14 of the CITA before they can obtain approval or continue their transportation business in Nigeria. How feasible do you think the enforcement of this requirement will be?
Well, that's a very good question. The provisions themselves appeared to have been necessitated by difficulties that the FRS thought they were having in enforcing the provisions of the current law and the lack of data on which to actually assess level of compliance by operators. But at the end of the day, I think we have to strike a balance between what is practical and what is not practical. Requiring companies to submit their global accounts in Nigeria just because they were coming to carry cargo in Nigeria, I think that's impractical. The authorities should be concerned only with information pertaining to Nigerian trade. So for me, it's a mixed bag. I think clearly the tax authority do require information, and it is legitimate for them to include provisions in the tax law that would enable them to obtain that information, which allows them to carry out their statutory function. But all we can do is appeal to the government to be reasonable in the level of information that they requested, and to imagine the steps that companies will have to take in order to comply. What you don't want to do is to make it so onerous. For example, we read in the press a few weeks ago that, that certain shipping companies had received certain assessments from the tax authority in Nigeria, and on account of that, we're now refusing to come carry cargo in Nigeria. Clearly, you don't want to push operators to the point where they are not interested in coming to Nigeria anymore. That's a disincentive to business. But at the same time, if the request is reasonable, you want to go and sit down with those guys and say, come on, guys, nobody's asking you to do anything here that you're not having to do in other parts of the world where you operate. So there's no reason to avoid coming to Nigeria when all you are doing in Nigeria is what you do everywhere else, right? Nigeria is not an outlier. Nigeria is not imposing any burden on you beyond what other countries do. Now, so long as we can teach ourselves in that realm where what we're doing can be seen to be fair, I think you'll find that the tax-paying private sector will respond positively. But when we begin to, in a sense, overreach, then, I mean, people do have options, right? But I think the common sense approach adopted by President Tinubu and his special advisor on revenue, who weighed in on that matter, together with the leadership of the FRS, who also weighed in on the matter, I think the approach is one that should be commended and hopefully will lead to a successful resolution of the matter between the shippers and the federal government, and Nigeria will be the net beneficiary. I hope I've answered your question. I've tried not to attack it too directly, but I hope I've spoken enough to answer it.
I would like to think so. So thank you very much for the answer. So we'll move very quickly to the next question. And this question is around the recent removal of the incentive for the tourism sector of the hotels. So it says Section 37 of CITA provided that 25% of incomes in convertible currencies derived by tourists by a hotel shall be exempt from tax, provided that such income is put in a reserved fund to be utilized within 5 years for the building, expansion of new hotel conference centers and new facilities for the purpose of tourism development. Says this provision has now been deleted. It says this seems that the government is revoking the tax incentive given to companies, hotels that earn income in convertible currency derived from tourists. Is the government looking to disincentivize the tourism sector and focus on other sectors? What really is the implication of this change?
I think it's a valid question to ask. Clearly, some hotels were benefiting from these provisions. And of course, if you then put the monies to use, in refurbishing the hotel, expanding your facilities, making yourself more ready to take in tourist traffic, then you would qualify to take the incentive under the old law. But with the Finance Act and the explanations that were given during the stakeholder sessions that were held, it's clear that it was thought that these provisions were redundant. And in any event, I guess the tourist traffic into Nigeria is currently at an all-time low. So it was probably felt to be redundant, unfortunately, but we'll have to wait and see how it shapes up, especially as we approach the commencement of the legislation. How badly does this pinch? I would imagine that the hotels would feel the pinch. But then how many hotels are even in a position to pay tax in any event? If you look at the margins of the hotel and leisure sector in Nigeria, they've taken a real battering over the last few years. Margins have been extremely eroded. I think you will find that many of them have made losses, and you don't pay tax on losses, thankfully. I think we need to think through how we're going to re-energize our tourism sector. Nigeria used to be a next tourist destination back in the day, at least when I was growing up, both for local and international tourism. And there are agencies of government at federal and state level that are charged with incentivizing and supervising the tourism sector. I think we will need to have an understanding of what's needed to revitalize that sector and the participants in that sector. Hotels are some of the participants, of course, but they are not the only ones. We have to think through the entire value chain of the tourism sector and how they can be optimized to attract traffic and galvanize both local and international traffic to Nigeria's tourist attractions. So, but for the time being, it seems to me that the planners of the economy did not really think much of the tourism sector, which is why they're beginning to tinker with some of those provisions.
Excellent answer. I also share your sentiments. I do think that Nigeria has tremendous tourism potential, which is currently undertapped, particularly amongst citizens of the country. There are a lot of people who don't even travel outside of the states where they're born, and something has to be done about that. I think we're a culture-rich country, and it'll be very nice if people get to experience the diversity in our culture. So we'll move very quickly. We're fast spent for time, so this will be the last question for the session. We're supposed to wrap this up at 12 o'clock. The last question is around the definition of building. It says the definition of building is revised by the Finance Act of 2023 to include structures permanently affixed to land for most or all of their useful life, excluding easily removable fixtures or structures such as mass transmission lines, vehicles, and mobile homes. It says, how does this amendment affect the construction and real estate sector of the Nigerian economy?
Well, when I look at that definition, and that's a very important question, when I look at that definition, though, I don't think there will be much of an impact on the construction industry to the extent that there's no substantial change in the treatment of land and buildings from the perspective of the construction industry. So if you were, so obviously fixtures, easily removable items would not be considered part of land and buildings. But if you were building a permanent structure, a house, for example, a house will be part of land and buildings. So I think the definition has provided a lot of clarity as to what should constitute land and buildings. I think it'll have more of an impact in the telecoms industry, where, for example, or maybe if you take a narrow view of the construction industry and take a section of the construction industry that provides services to the telecoms industry. So if you were building, say, for example, masts and other appurtenances, will that constitute land and buildings? I think you will find that things like mobile caravans and the like, now there's a lot more clarity as to what should be taken to be a permanent attachment to land and what is not. I remember back in school, they taught us about what constituted a permanent addition to land as to be constituted as part of that land, and what constituted a fixture, a movable, that will not be part of land. And the Finance Act has clarified that for what is land, which includes permanent fixtures, there should be no VAT. So obviously, some elegance is required to then know, what can I charge VAT on? It should be on the movables. It should be on things that are not permanently affixed to land. And I think that definition has elegantly addressed that question. Or, I mean, do you think there's a gap? I mean, what do you think?
Personally, I don't see the gap. I think you've addressed the question succinctly. It seems the definition is specifically, or the amendment is specifically targeted at alienating items which are fixed to land, like you said, things like masts, transmission lines, vehicles, and mobile homes. The necessity to exclude vehicles seems a bit strange to me, but I can't see where must come from, because you would typically find that those things are valued alongside the land that they're built on sometimes, and they're classified in the same bucket. And therefore, it would mean that if you were to sell such an item, you might have exempted it from VAT. So this is I think it clarifies how those items will be treated for VAT purposes. So thank you very much, Ajibola.
It was a very welcome introduction. So you'll see that over the last 3 Finance Acts, the definition of land and building has been tinkered with. And that tells you, I should tell any informed reader, that there's something going on there. And what is going on there is that there had been a lot of doubt in Nigeria, a lot of gray area as to what was vatable and what was not vatable. In fact, at a point, it was thought that residential landed property was taxable. And then at a point that, oh, actually, residential landed property is not taxable, it is business landed property that is taxable. So, I mean, all those controversies had to be addressed. And the beauty of the Finance Act is that there was an initial attempt to address it when the experience on the field showed that redefinition created unintended consequences. The following year, it was amended again by another Finance Act. And in the 2023 Finance Act, there has been a further amendment of that definition. So you see that it is the perfect example of the kind of matters that come up for consideration in Finance Acts. Things that are topical, things that are being burdensome on taxpayers, or that are causing conflict between taxpayers and the tax authority, with a view to improving the system. And the definition of land and building in the 2023 Finance Act takes the definition into a point of safety where there is now significant clarity between the taxpayers, the government authority, the FRS. Everybody is clear as to what should constitute land and buildings now. And we must thank the National Assembly and the President for walking this line.
Okay, thank you very much, Ajibola, for that answer. I think it's been a very enjoyable session. Unfortunately, we don't have a lot of time left. I'd like to go on because we do have quite a lot of questions to cover in the chat box. But it's been a very engaging session. It's been very insightful for me personally. I hope everyone shares the same sentiment as well. Just to reiterate that this is one of a series of engagements which KPMG will be, doing around the Finance Act. Like Ajibola already mentioned, we do have an impact analysis and insight series, which we published every year since the first Finance Act. And we have one on this Finance Act as well. So if you would like to gain further insights into the provisions of the Finance Act 2023, do visit our website and download the impact analysis. Also to thank everyone for joining, and special thanks to Ajibola Olomola for gracing us with his presence and
Thank
his
you very much, okay.
and experience. So
Thank you very much, okay, for having me. It's been a real pleasure.
You're welcome. You're welcome. Unfortunately, there's some questions we were not able to take. So if you haven't had your questions answered, please feel free to reach out to us. An email address will be shared subsequently where you could direct your questions. I'll be happy to take them. That being said, I think it's been enjoyable, like I said, and we appreciate everyone for attending, and thank you for joining the session. Have a good day. Any final words from Ajibola?
The Finance Act of 2023 is a very significant piece of legislation, like we've tried to demonstrate over the last 2 hours. We could have spent even longer talking about it and still have things to talk about. So I would encourage everyone to try and obtain a copy of KPMG's insights into the matter, and also to engage with your local chapter of the organized private sector so that you can get your views across together with that of your tax advisors. And let's enable the President Tinubu, and his team to obtain relevant insights that enable them to take an ultimate decision around the provisions of the Act and the special fiscal measures, the things that need to be recalibrated, the ones that we definitely need to stay, and things that we may probably want to see some revisions to. We have time between now and September to influence the direction of travel. And I will encourage everyone who is interested in this matter to try and get involved in the dialogue, so that come September, we can all work positively towards, doing things in the manner in which they should be done, without anybody carrying more of the tax burden than they ought to. We can then evolve towards a fairer system. So I thank you for your interest in this session this morning. It's been delightful for me to be here and to talk about these issues. And I look forward to having you and to engaging with you in future such discussions. Thank you very much. And thank you, Goke, for being kind and not asking me too many difficult questions.
Thank you very much. You're welcome. Very much. Okay.
This isn't the world you grew up in. You've become an expert in areas of the business that go well beyond tax. Your organization is more global, increasingly digital. Your business models are more complex. Compliance is getting complicated, and penalties are more severe. Governments around the world have moved towards taxes that are easier to collect and administer through technology. Suddenly, your board wants to hear from you about risks and opportunities, and you're not the tax leader you were when you started out. You know how to transform your tax data into meaningful insights. And if you're anything like the other ambitious, future-thinking tax leaders out there, you've managed to do all of this with fewer resources and less budget. Maybe these tools still feel disconnected from one another. Not anymore. Introducing KPMG Digital Gateway, the single platform solution that gives you access to the full suite of KPMG tax and legal technologies you use. Across our global network, we are investing $5 billion over 5 years in technology, people, and innovation to accelerate the digital transformation of KPMG firms and our clients, and more than $1 billion in tax and legal technology specifically in that period. KPMG Digital Gateway puts the fruit of our investments at your fingertips, bringing together the expertise of alliances, technology solutions, and the KPMG global network of professionals into one integrated platform. Putting our investments in machine learning, deep analytics, visualizations, and AI technologies in one place, all driven by the rich data you already have on hand. Powered by Microsoft Azure, built on the cloud. KPMG Digital Gateway and the teams behind the solutions are working together to help change the lives of tax leaders and their teams, redefining target operating models and transforming tax functions for the new world order. You've done so much already. Just imagine what the future of tax will be with a platform like this behind you.